We're back with Costa Vallenas at UBS in the UBS garden, I guess you could call it, Costa, here in Verde Valley. For a long time, we've been talking about the role China's been playing in the world economy, and obviously there have been some doubts around, just how quickly the Chinese economy is growing. A few analysts have cast doubt on the official figures that are published. What's your sort of take on China's growth at this point?
Well, in terms of the official figures, we've been looking at China for a long time. And if you go back in history, there have always been questions related to GDP measurement. And this is nothing new. And there are many analysts looking at various indicators such as electricity production, exports, things you can measure, looking at specific companies. And this is not a new debate. Bottom line is that the Chinese economy has an unusual problem, which is that it seems to want to grow too fast. And you can see this in terms of pollution measures. So there's too much pollution as one consequence of this growth. And another consequence of this growth is that you have pressure on property prices, and the authorities therefore are trying to cool this economy to get to a kind of a more sustainable long-term growth profile. So the issue that the Chinese economy is facing is how to get to a sustainable growth level, somewhat lower, to take care of these other imbalances that we are aware of.
You alluded to some of the challenges they're facing, and how does this change the model for China? Because obviously China's development so far has been largely built on the back of a manufacturing export-led model, and now in an environment where there's perhaps not as many regulations and laws as somewhere like the EU or the States, they're going to have to introduce measures to curb inflation, to curb pollution, and put some environmental controls in, as well as, they're seeing rising wages in China. So what does that mean for the Chinese model going forward? Can they sustain this current model, or do they need to adapt and change it? And is that happening?
Well, one thing we can say is China is becoming richer. And in a sense it's following classical textbook case of what happens when you become wealthier over time as a nation. The value chain changes. You can no longer produce the things that you did at the early stages. Your currency becomes more valuable over time, and this forces you to move up the value chain. And this is what China is now facing. If you look at its currency over the last 2 years, it's 10 to 15% more expensive relative to its trading partners. And we have the laws of economics just forcing manufacturers to look at those areas where they can add more value. So the model is changing, it'll continue to change, and it'll reorientate China towards a more domestic growth model. But these are not easy things, and they take time.
And it's not just a case of just producing very vanilla or commoditized products anymore. You are seeing signs that they're moving up the value chain in terms of the output that they're producing.
Yes, you can see that. You can see that in many areas, and you can see this in terms of plans that they have to produce new things, also to move into the aircraft industry, for example. So China is following a very classical approach of moving up the value chain, and this is what many countries have done.
And a great problem to have, cooling down and trying to slow down rather than speed up the economies at this point.
It is perhaps a good problem to have. On the other hand, it is a difficult challenge, because how does anybody know how much cooling to introduce, which lever to pull? There are important aspects of the Chinese economy that aren't market-oriented. For example, interest rates have not been liberalized. The state still sets interest rates at banks, and this obviously means that there are many aspects of the market that aren't sending you the necessary signals to make these adjustments. But there's a process underway.
We've done a little roundup of the major economic centers in the world now, and now we get to the point where we've got to start talking about, well, what do people do with their money? You've got a very good idea around the different sectors and asset classes that you would like your clients to be underweight or overweight to, or neutral. Just take us through, starting with equities, what your thesis is at this point.
Well, I'd assume many of the fans of your program are people who tend to be well invested and diversified. Ironically, this is not the case with investors generally. Many are sitting in cash, sort of waiting for opportunities while their cash is being eroded in terms of zero interest rates in US, Europe, and different parts of the world. And what we'd advise investors to do really is to tilt their portfolios towards increasing allocation to equities. So we have in our reference portfolio a slight overweight on equities, for the simple reason that we believe that having access to these diversified revenue streams that equities provide will help the portfolio going forward as the global economy gradually improves.
You're also expecting you're expecting earnings growth in the US, and is that your kind of favored market amongst developed market equities at this point?
Yes. So in the developed world, we have a preference for the US. The US economic engine has restarted. We see earnings growth, and we see expectations of earnings growth looking good, and this is helpful to the US equity market.
You've also encouraged clients to be underweight sovereign debt in the developed markets and very, I guess, overweight in corporate debt and high yield debt. Just take us through what you expect from that asset class in particular.
Right. So in terms of government debt of developed markets, we have a situation where these governments are highly indebted. Central banks are keeping the yields artificially low by buying this debt in many of these economies. So we are not being compensated as investors for the risks, the inflation risks linked to this debt. And this is why we would rather allocate investment to corporate bonds, in particular investment grade, also in the high yield space, but in a diversified basket. And in particular, we also like emerging market corporates.
Emerging market corporates, and there's a very interesting scenario taking place there, and I think you took me through it off air, but essentially tell us why there are more and more emerging market corporates tapping foreign denominated sources of capital in the fixed income space.
Yes, well it is evidence that things are quite good in the emerging markets in generally, because if you go back 10-15 years, emerging market sovereigns, many of them were unable to borrow from their own people in their own currency. And emerging market sovereigns had to borrow in dollars. And over time, as emerging market sovereigns improved, you had a situation where they were increasingly able to borrow in their own currency from their own people. And as this happened, they borrowed fewer dollars relative to the size of their budget. And this has opened up the opportunity for emerging market corporates to tap the dollar space. The interesting thing about that is that emerging market corporates on average are not as well known. So investors know the names of countries, but they're not that familiar with the names of emerging market companies. And this means that good emerging market companies have to pay investors a little more to entice them to buy their bonds. But many of them are cash rich, they have good fundamentals on average, and in a diversified basket, this is something that we would certainly look at.
Quite an interesting view. Obviously, a very topical debate happening in South Africa with regards to our economy, because we're quite heavily reliant on resource and commodity companies for our export earnings, and that's obviously very reliant on how much China will consume going forward. You're neutral on commodities at this stage. Take us through that reason, and I think answer specifically for us. Do you still see this commodity boom continuing, that like we've enjoyed in the last 12 years?
So we're neutral on commodities because we don't believe that the levels of growth that we're seeing globally support a particularly strong commodity recovery. So neutral is not a bad position to be in, because it means you're allocating money to commodities, but it's not a case for a very strong commodity story, simply because the global growth is not at the levels you want to see. Going back to the point, are we going to return what we saw, the growth that we saw in 2004, 2005, 2006 was the best of times, best of years, boom times. There's no forecast that's taking us back to those levels anytime soon. And we also discovered that a lot of that growth was poorly financed. And so we don't necessarily want to go to back to those same levels of growth.
So at this stage, very, very neutral, but in terms of China itself, do you see it consuming the same amount or the same type of commodities it did in the last 12 years going forward?
Well, you could imagine that as the Chinese economy rebalances and redevelops and reestablishes itself in different sectors and becomes more domestically focused, you would expect to see changes in the commodities that China imports and uses. So that's a very natural development. And this also explains why China may be importing less of certain types of commodities. But it's something that should be expected.
The last time you were out here in South Africa, you had done some research around emerging market currencies. I think for the benefit of our viewers, just take us through the research that you did then, and then we can talk a little bit about how that plays into the asset allocation model that you've developed at the moment.
So this ties into the issue that emerging market sovereigns have improved over the last 10, 15 years. And as they're improved and opened up, their currencies have become more interesting to investors internationally. So typically when you think about investing in emerging market currencies, investors don't view currencies typically as an asset class. The case that we made in our research is that you can make that case for emerging markets because they do act differently and they give you a higher yield on average in a diversified basket than you would get for developed markets. And this is especially true now that you have zero interest rates in large parts of the world.
So you had a specific set of characteristics that you found in many of these emerging market economies that you would be willing to invest in their currencies. Just color that for us a little bit more.
So I think the point is that these economies are very different from each other. Some have very low interest rates, for example, China, but there we see the currency appreciating over time. Some have very high interest rates, for example, Brazil. And the point is when you put these currencies into one basket, and there's about 23 of them that are defined and tracked in an index, this diversified basket of 23 currencies gives you an average return of 3% to 4% over and above what you would get holding the G4 currencies. G4 currencies being US, Japan, Euro and Sterling. And the point simply is this is more interesting to investors who are looking for opportunities to diversify into emerging market assets.
Where does the South African Rand stack up in all of this, Costa?
The South African Rand is cheap, relevant to its 2-year history in real effective terms. It is cheap when compared to a range of other emerging market currencies. And it fits into this basket in the sense that there's more allocation in a portfolio context to emerging market currencies. And so the Rand benefits as being one of the currencies that is bought for this basket. So there are issues in the South African economy that are unhelpful to the Rand. Current account deficit, fiscal position is not great. You want to encourage exports, so you want a somewhat weaker currency. But there are external factors that support the Rand, which is whenever the Rand becomes too cheap, investors see that as an opportunity to add it to their diversified portfolio and to get a bit of extra yield.